From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It is Wednesday, April 1st, and you are listening to a special bonus edition of the HPS Macrocast. Tony Fratto coming to you from the hills of Western Pennsylvania. John Fagan and Brendan Walsh. Brendan, where are you guys right now?
Washington, D.C.
Yep. Both in Washington still.
Yes, indeed. Holding down the fort.
Okay. Well, I'm glad you guys are down there holding it down.
Yeah.
The truth is,
it's a nice place to ride this out.
Good. As long as, well, the liquor stores are still open there. They're not here.
Yeah.
So,
oh my God.
It's a little bit rougher in Pennsylvania right now. But look, that was, I think, we made it to April 1st. We should be congratulating everyone that we actually made it to April. It was a hellfire of a month of March, probably the worst March on record. Certainly was for equity markets. It certainly was for lots of businesses. You look a month ago at passengers flying on airplanes relative today, and they're flying 1/9 of the a load that they were a month ago, and going down from there. It was, one of the most brutal months of March ever. But here we are in April, and the things that are different between then and now is we had the Fed take lots of action. People forget it was on March 3rd. So not even a month ago, March 3rd, that which was Super Tuesday, that Jay Powell, Fed chairman, surprised the world by announcing a 50 basis point cut in the policy rate. That was, not a month ago, and which is just amazing. I guess it was 4 weeks ago. Amazing that it was that recent, and all of the actions that the Fed has taken since then. We have also seen fiscal action by Congress and the Fed. Again, in that time period, they've passed not one, but two stimulus bills. One relatively minor, but good policy in it of about $8.5 billion, and then a gargantuan, $2.2+ billion package. And then we have seen the first evidence of, or $2.2 trillion package, and then we have seen the first evidence of the hit to employment just in the past couple of weeks, and got some clues on that. We're going to talk about all three of those this morning. First, I want to talk about the Fed, and very specifically, we have spent some time on the liquidity provisioning work that they've done. But what they did yesterday, which doesn't get a lot of attention, it's not very well understood here, is they it is in fact, it's a repo facility for central banks around the world. It's open to almost almost any central bank of any significance. They have previously done currency swap lines. So we want to talk a little bit about that. We'll talk a little bit about the stimulus bills and what we see from them and how they're working. And, we got some details from Treasury and SBA on how people can apply for those programs and what we think they're going to do. And then we're going to look ahead to the two monster job reports this week. We have, payrolls reporting on Thursday, and unemployment insurance weekly claims on Thursday. And then payrolls, non-farm payrolls on Friday. So
Tony, I think that
John,
talking about the Fed is what the Fed is doing is really important, because in the popular narrative, the Fed actions are getting a little bit lumped in with the fiscal narrative, and I think it's important to explain to people that the two are kind of totally different.
Yeah, and we know that a lot of the liquidity work, right? The stuff that they did from that go back to the global financial crisis, all of the liquidity provision and trying to create markets and support markets for assets and help make sure that all parts of the financial sector, whether it's money market, cash market, overnight cash markets, the corporate paper facility, some of these are new, but it's basically to keep all of the plumbing moving, and so you don't get a seizing up of the financial system. We've paid some attention to that here. They're also doing QE, of course, and they've gone to the zero bound on the policy rate. The thing that hasn't got any attention, which I think is interesting, and not just for some former Treasury nerds, but is the swap lines that they opened up with central banks around the world, some major central banks. And then yesterday, this repo facility. John, why don't you walk us through both of what they did with both the swap lines and the repo facility, and explain why is the Fed doing this? To me, I've said, look, the Fed is especially in times of stress, the Fed is the central bank to the world, and that's kind of what we're seeing here, isn't it?
That's absolutely right, Tony. Thank you. As you say, to step back, I mean, the Fed has been running plays like Tom Brady in the 2-minute offense. I mean, they've just been, it's rate cuts, it's QE, it's more QE. The deep ball down the middle was the unlimited QE for purchases of Treasury and mortgage-backed securities. But they've just been going through the playbook, much of which was written, as you know, in 2008,
Does Brady still have a deep ball?
maybe better. I haven't
seen the deep ball from Brady in a while. Haven't really?
We'll
he
see.
plays for Tampa Bay now, so we can criticize him.
I don't know about the deep ball though.
But anyway, the Fed has really, as you say, the dollar liquidity and running plays to running the plays to basically dampen the strains on dollar liquidity overseas. That wasn't the very top of it. It wasn't their first kind of priority. It wasn't the top of the playbook. It was a few pages back. But the Fed was obviously got around to it as they saw overseas demand for dollars, particularly when you're looking at the most common ones you look at are euro and yen. That was showing extreme premium for getting access to dollars, which suggested, which obviously indicated just a drying up of dollar availability overseas. We had a lot of contacts with folks on the street who were complaining about this. It's called the basis. Basically, is what they call it. It's above the sort of interest differential that you pay to get access to dollars, and some of our contacts basically characterized those markets as broken for a while in the middle of March, and access to dollars was extremely tight. The Fed's swap lines, those came into play in 2008, 2009. Those are with a limited number of central banks and foreign central banks to swap dollars for foreign currencies. And so the kind of currencies that you want, without taking too much risk in the trade, you're going to be swapping with tend to be, very well more developed sort of peer currencies and so forth. They expanded.
We have standing swap lines with the number of central banks. So I think it's a Bank of England, Canada, European Central Bank, Bank of Japan, and then the Swiss National Bank. Those are our standing swap lines that the Fed has with other major central banks.
Right, and they expanded those to I think it was a total of 14. I guess 14 now.
14
central banks,
yeah.
Including they opened it up Australia, Denmark, and Brazil,
Norway.
other. Like they obviously widened the scope as dollar liquidity got really got stressed overseas, and this was beginning to show some good effect. Certainly, as we saw dollar availability look better, particularly in the euro and yen, which you can see pretty easily, and then we saw the dollars spike, which occurred at the height of market tensions in the middle of March, and come back off. The dollar demand overseas doesn't always directly translate into strength of the dollar, but it typically does.
Yeah, what is good? What is the? I don't think I think it's hard for people to understand. Like, why is there this global demand for for dollars, and why is it peak right now? Like, what is? I mean, we know that the sort of old, which we've talked about before, is there's the regular, just a flight to safety, right? People are looking for a liquid market that you can get in and out of and park dollars. Park if you have dollars, right, you go buy treasuries. So that's why you need your dollars, right? So you can go buy treasuries and then sit and wait until the storm passes, right? And then you can go sell those treasuries, because it's a big, when we say it is a big, rich, liquid market, the big is big, it's available to everyone, it's rich, it's a lot of players with a lot of money involved. Liquid means that you can get in and out of it very quickly. The chances of you not being able to sell a treasury 10-year note normally is really slim. It's impossible, right? I mean, there's always a buyer on the other side of that trade, right? So that's the liquid part. So you've got dollars, and it's the next best thing to keeping cash, which is the ultimate liquidity, right?
Sure.
Yeah.
Okay, this is a great question.
But why is it more indifferent now?
Yeah. Because the answer is interesting, why people need it, but also the answer explains too why it's just very difficult in this world that we live in for the dollar to weaken too much.
Yeah, I mean, part of it. Yeah, I mean, basically, as you say, Tony, there's the rush to safety, as the global reserve currency, and treasuries are the safe haven asset of choice for investors. And that's a privilege that the United States enjoys, but it also creates its own problems, because dollar strength can basically be a self-fulfilling and self-reinforcing and pro-cyclical to the downside kind of problem. Why is that?
Right.
If you are overseas, so much of the business that you do, so much of whether it's financing trade or taking on debt or so on and so forth, you're doing it in dollars. And if you're if your revenues and your streams of income are in another currency, and the dollar is gaining strength against that currency, this is a classic squeeze that we see typically happen in emerging markets, but it can happen in other countries as well, where all of a sudden your dollar-based liabilities are going up in value against your falling value of your income and revenue streams, which makes you scramble to get into dollars to try to get ahead of that, try to get ahead of that squeeze. And that's sort of part of the real economy aspect of a scramble, a forced scramble into dollars. And that's in the real economy side. Obviously there's a in the trading world and financial world as well, you've got investors and companies with investments that are in dollars. Those are going to be, potentially on the hook to post more collateral. You've got to be getting, because the value of those are going down. You're going to be trying to get out of trades. You've got to be getting, and a lot of those investments are denominated in dollars. You've got to have access to dollars. You're going through your local banks. You're calling up, you're trying to get out of you're trying to get out of your position in emerging market bonds somewhere. Yeah. That's going to be going back into dollars. It's it's both real economy and financial sector demand that, alongside that just organic safe haven demand, that really pushes people into the dollar to try to get their hands on it for a variety of different reasons. And when the dollar increases in value, it increases the urgency of doing so.
Yeah, and so that's a really important point, where a lot of financial markets go up and down because investors are making decisions. The currency markets, especially the dollar, is really much more driven by Main Street. It's companies that have to make decisions, and then Wall Street is a little more on the outside of it, that in terms of moving it.
And dollars become in that situation, they're the lubricant between non-dollar economies too, right? I mean, it's easier for Brazil and Australia to to trade in or settle accounts in dollars than it is in each other's currency, because you have currency risk, and the markets are thinner for their own currencies than they are for dollars. So there are lots of reasons why dollars are necessary.
And an interesting data point is, Visa is the largest trader of currency in the world on a daily basis, because so much of their income comes from cross-border people, using your Visa card. So every day it's a company, and they have to exchange, Aussie dollars for US dollars and things like that.
Yeah,
such a great point.
And that's why, that's why this week's important repo operations that the Fed opened up to foreign central banks is so important, Tony. And you mentioned that distinction between the swap lines. The swap lines are, they have standing swap lines with some central banks. They opened it up to some more, but it's really a very limited number. The repo operations are far more expansive. The ability, basically, if you're a foreign central bank holding treasuries and you have an account with the New York Fed, and pretty much all of them do.
That's that's about 170, roughly 170 countries around the world have an account with the New York Fed.
Right, and I saw a number of 5 trillion of sort of treasury holdings there. That's big, and the ability for those countries to post that treasury as collateral and receive dollar liquidity from that is an operation that, for the Fed, kills 2 birds with 1 stone. The foreign central banks were forced sellers of treasuries because their real economies and their banks were demanding dollars. Their dollar liquidity is tied up in treasuries. They were forced to sell those treasuries to get access to dollars after a certain point. And that was, potentially troublesome for the treasury market. You never want to see forced selling in your market, and dislocations did occur in some of the price action in treasury markets in mid-month, which is very rare. And so the Fed has kind of really gotten to both sides of the issue there by going through this. It's really widened the access to dollar liquidity while calming down potentially the forced selling of treasuries.
And so the brief is maybe we should have even started with just an explanation of what the two are, but they're not complicated, right? A swap is it's basically the Federal Reserve and the Bank of England basically credit a big number in their own accounts on today's exchange rate, right? You say you've got I don't know what the exchange rate is with the pound today, but 117 billion pounds in your account and $100 billion in our account, and there's your swap. And you just credit it. You just tick those numbers at this exchange rate with the swap to the exchange goes back at some point in the future at a steady price. So there is the foreign exchange risk is about 0. And then this it's actually not a whole lot more complicated than that. And then the repo facility it's like the repo market here is the foreign central bank, the National Bank of Italy, delivers lends treasuries to the Fed. The Fed gives the National Bank of Italy dollars with the agreement that they will reverse that trade it might be tomorrow, it might be next week, or it might be 3 months from now. They're relatively short-term repossession loans to get them through periods of through their liquidity needs. That's it, right?
That's exactly, yep. And that repo window is typically just available for, in the US sort of domestic market, and it's cash management for companies and banks. And the general collateral repo markets that we've seen have calmed down a lot as the Fed has poured a ton of additional, basically almost unlimited liquidity into those. And so that's also been calmed down. I think just a last note that even as dollar liquidity gauges show a lot less stress overseas, that doesn't mean that the dollar is weakening. Availability for dollars is, we're talking about, and this is the distinction that we're making on a markets basis in a lot of other places. It's functionality and then directionality. And you can have a functioning dollar market, which is the number one priority. The Fed wants to be, if people need dollars, they want to be able to get them. But that doesn't mean that the dollar is, that the supply and demand for the dollar isn't pushing the dollar higher against other currencies. And we're beginning to see the dollar turn higher again. And that's that's something that policymakers will have to be watching very closely.
Well, that was, I guess we could say it looks like they're doing the best to smooth this. It looks like it's working as much as it can, and keep an eye on it and see what more they need to be done. But the other piece of it, so that's monetary policy. Let's take a break and come back and talk about what fiscal policy is doing, because it's pretty big right now. We have a little bit more details on some of the lending programs that are going to get started here pretty soon. So why don't we take a break now? You're listening to the HPS Macrocast.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
All right, we're back on the Macrocast, special bonus edition on Wednesday, April 1st. And this is no April Fool's jokes at all. So no, that's not a time for April Fool's jokes. No one can be fooled about anything right now. We did, last week we saw the passage of this, enormous $2.2 trillion fiscal package, which we've been calling for a number of weeks. We should give credit that it actually is coming, quickly, very, very quickly for DC standards. Whether it's quick enough or big enough, we'll find out. But we've started to see some of the details on some of the lending programs. Grants for airlines are moving. The potential loans for airlines, they need to make their applications by Friday. So that's very quick, and we'll see which ones do ask for lending and which ones don't. The really big program, I think, that most people are rightly focused on, and it is really innovative, is a roughly $350 billion program for small and medium-sized businesses. Treasury released some of their details on this. Our friends at the Economic Innovation Group, EIG, put out a good primer on it. If you want to go to eig.org and check out their this is called the Paycheck Protection Program. This is an effort which I think, when I say innovative, and that has never been done before. The idea here is lend money to small, medium-sized enterprises on really concessional terms. In this plan, the interest rate is 0.5 percentage point. Really concessional terms, with the goal of retaining workers at these businesses, because we see this as a temporary downturn. Brendan, you actually went and looked at some. This is administered through the Small Business Administration, the loan application process. What did you see?
Yeah, so it's interesting. So there's two different loans. There's the disaster relief loan that has existed for forever, where, if you get hit by a hurricane, you apply. That is a relatively complicated loan. It would probably take you, if you had everything and the website was working up, maybe an hour to fill out, and you have to have your tax filing from the previous year, and it's kind of a normal loan application. But what they've done is, if you are a big business and you actually need a halfway decent sized loan, you apply for that. But and then they'll process it. But they've also streamlined that process to get money out the door immediately. So this process, they're basically giving you a $10,000 advance on that future loan that will come.
Just by applying, you apply, yeah. They send you a check for $10,000.
Yeah. So, and that one takes about 5 minutes to do. And basically all you need is your taxpayer ID. And then basically you put in your name and your bank account information. And they're trying to get that $10,000 out the door immediately. And that $10,000 is intended to be forgiven. If you get a larger loan, they're talking about maybe 90% kind of forgiveness. So that's one loan. And then, as you said, there's the payroll program, and that's entirely new with this CARES Act. And that is intended to, they're basically going to give you money so that you can then pass it on to keep your people employed. But also what I found in terms of talking to people is, and I think this is a good thing. So a lot of people that work in the service industry, especially if you make tips, it's better to just go on unemployment rather than for the employer to do the payroll. And that's the more efficient way. So one way or the other, I do think we're going to get money into people's hands. But the Treasury is a bit overwhelmed, especially with these small business loans. And the only way to do it, and the bill intended it for this to happen, is you go through your bank. So you already have your bank account and maybe a loan with, Bank of America or whatever. They're going to process it. They're going to decide, okay, you have $30 million in revenue and 500 employees. You need X amount. Bank of America will make you the loan, and Treasury will reimburse the banks. And I think that can actually be a fairly efficient way, and we can get out the money, in weeks, not months and years. Yeah.
So it's funny you mentioned on the ease of applying. I saw some, on Twitter, questions about the shortness of the application, the brevity of the application. And people say, well, it's easier to apply for this, these billions of dollars, than it is to apply for whatever it is, a credit card application or a home loan. And there's people were critical of it. To be honest, it's the exact opposite. I mean, what you want here, the most valuable thing today is the speed of getting this money out. If you are applying for this money, you're going to make attestations that you're going to keep your employees, that you're not seeking any other federal money anywhere else. You're just going to attest to this, and it will be on the back end for your bank to determine whether you have in fact done that.
Right.
Because
part of the application, your business had to be on the books before January 1st, 2020. So, maybe you can do some fraud and get the loan, but when we do the accounting in years, it's just going to be impossible to not get caught, because you have to have a tax filer ID. Payments. Exactly.
Right. Yeah. Yeah. Okay. So then the question is, so let's say this money does get out. It's April 1st. One of the things about April 1st is people have their rent due. They have their mortgage payments due. Payroll is, maybe it's Friday for a lot of people making payroll. A lot of this money is going to get out fairly quickly. Is it going to be big enough, and is it going to be fast enough to have the impact that we hope? And I think what we're seeing from some of the private sector estimates out there is that there's nothing preventing a pretty enormous hit to GDP in this quarter, is there?
Yeah, this quarter is going to be terrible. And I think in terms of estimating whether it's enough, it's entirely dependent on how long we have to be shut down. If we have to be shut down for a month, it's probably enough. If it has to be 2 to 3 months, then we might have to do phase 4, which apparently the House is already working on.
Yeah, from a market's perspective, it's really hard this isn't the typical kind of formulation that market participants are used to following. The Fed really has been the star of the stimulus show in the global financial crisis and the post-crisis era. And so when the Fed would pull the QE lever or do something, you could see the effect, so quickly. It was executed fast, and it hit the markets in a big, straight to the bloodstream kind of rush. And you could, when market participants are used to that instant gratification aspect of Jay Powell coming out and saying, okay, we're going to do X, and then the market turns around on a dime and starts heading northward. when you have these slower moving programs like this, and you have a lot of, as you both said, tons of uncertainty about just how deep the impact is going to be. And even if companies and small businesses and households are getting the money in the short term, because of the social distancing and all of the different restrictions that we're all still under, the fact that they're, staving off insolvency still isn't really going to be boosting economic activity in the way that those kind of numbers would suggest. And it's basically keeping the economy on life support. And that's really, and it's pretty hard. It's going to be pretty hard for market participants to see that in a real time basis. And so we're going to be doing a lot of guesswork. But one of the things that we've seen this week, just over the last couple of days, is this increasing concern among market participants, or maybe an acceptance that even on the other side of the infection curve, the economic healing is going to be halting, slow, fitful, uneven. We can see that in Asia with, a lot of the countries in Asia by the metrics that they publish are past the worst of the outbreak, but still, a lot of measures are staying in place and have to come back, and you see secondary flare-ups and so forth. And that's the kind of thing that, markets are now beginning to come to grips with.
And I think that's a really important point, where actually bending the curve by shutting down, while it's difficult in our day-to-day life, the things you have to do is easy. Everyone stays home and we test. Reopening is the hard part.
Yeah, and especially as John, you mentioned, which I don't know that it's front of mind for a lot of people here. It certainly wasn't by, the president when he was, predicting, let's try to get back to work by Easter, which is in 2 weeks, was not considering what we're seeing both in China and Japan now, which is, it's a double dip, or a double hit, where it's potentially coming back again.
But
which
the press conference last night was one of the most somber ones I've heard outside of war.
Yeah.
So I think the reality is hitting people.
Yeah, we've been talking about the economic hit. What they somewhat formally announced on their where the potential fatalities estimates, which are pretty horrific numbers, estimates of 100,000, 40,000 additional Americans dying this year because of COVID-19. Those are horrifying numbers, and hard to even wrap your arms around what that means for that's 240,000 additional funerals and broken families and that are going to happen over this period. So it is pretty damaging on many levels. But hopefully that some of the economic actions that we've seen can help mitigate at least the economic impact. Well, one of the measures of the economic impact we're going to get, two of them. We're going to get two jobs reports this week. Why don't we take a break and come back and talk about what we think this means and whether the data mean anything at all right now as we look at some of the data coming this week. You're listening to the HPS Macrocast.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The HPS Civic Science Economic Sentiment Index accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
All right, we're back on the Macrocast. Hey guys, quickly, we've got two more jobs reports. We saw unemployment insurance claims, the weekly claims data, the initial filings last Thursday were an enormous number, 3.2 million people filing. That was more than 3 times the largest weekly report ever. Estimates we're seeing this week, also huge. And then we have the non-farm payrolls on Friday. Brendan, what should we expect from these numbers, and what do they mean?
Yeah, I think the one to follow now is the claims, because that's just with a 1 week lag, and those are actual checks. So that's the amount of people that are out of work. Down the road, the jobs number is going to be important, but also a lot of those people aren't able to be in the office. But most importantly, in terms of the non-farm payroll, when they ask an employer, they ask, was that person employed on the week that included the 12th of the month? So that week was like the 8th, 12th. So a lot of the shutdowns nationally hadn't happened yet. So this number that we get on Friday might look a lot less bad than the reality. So I think the focus for markets, but also policymakers, should be on the claims. And I was reading yesterday, California is already up to about 1.6 million this week. So you're going to be talking about 5 to 6 million people each week that are unemployed. And it's
we should just we just said just a little bit of the mechanics behind both. There are actually two numbers. So when we say we talk about the unemployment rate and we talk about job creation, the rate comes from the household survey.
So that's actually a survey that they called you and I and say, are you employed? The jobs number comes from the employers. So in terms of the thing to focus on the Friday's employment, I think is more on the unemployment rate, because that probably can quicker capture whether you're unemployed, where the jobs number is a point in time, and also it'll get revised over time.
Yeah. I feel like usually when we see some change in the monthly employment job creation numbers, the payrolls numbers, we say, well, don't trust that number this month. There's a lot of noise in it. This one we're saying, don't trust this number because there's not enough noise in it.
Yes, exactly.
Right? It's missing. It's coming. The survey is coming before most of the noise started happening, and so it's not going to be a good number, but it's not also. It's also we know anecdotally, just what we're seeing with our eyes and what we're reading in the news, that the actual unemployment numbers, job creation numbers, are much worse than what we're going to get in this report.
Yeah, and it's hard enough for what the BLS does to be able to do this on a monthly basis and get out the door. So this is one of the most timely numbers we have. They get it out the door a couple of days after the month end. I can't imagine what you're talking about, 5 million losses. And also a lot of these people have to do it from home. So, I think they're doing an amazing job, but the first cut at it is not going to be what the last one cut looks like.
Well, we're like everyone else, we're guessing at it now. When we come back on Friday, we'll have the actual numbers and see what we can read from them. And we'll take a look at that. I think we had ATP out today also, which is again a nothing number that we can nothing to read. Those are private sector employment, again missing most of the noise as well. Yeah. Okay. Well, we'll be back on Friday. Thanks for joining us for this bonus edition of the Macrocast. John Fagan, Brendan Walsh. I'm Tony Fratto. We'll be back with you on Friday. Take care.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.